Hello, everyone. I'm Dr. Tom Snyder, Senior Director, Transition Services for Henry Schein Dental Practice Transitions. I am the partnership specialist for our division, and I want to share with you some of my ideas about partnerships. I've been involved in partnership consulting for over 30 years, and I've seen lots of successes and some failures. And what I'm going to try to do today is give you some basic understanding of what's involved, because no two partnerships are alike. They're highly personalized. And I think as you begin to hear what I say, I think you'll agree with that supposition. So what we're going to cover today are some of the economic and business considerations for a partnership, common partnership entities and buy-in strategies, multiple entity partnerships, key issues in addressing a partnership agreement, and common methods for structuring partner compensation. A lot's changed in the last 15, 20 years in dentistry. When I graduated from dental school, the majority of my classmates wanted to be solo practitioners. So almost a generation ago, about 90% of dentists were solo practitioners. As of 2009, the ADA's Health Policy Institute reported 59% of doctors were in solo practice. 2015, we saw a 6% drop to 53, another decline in 2020 to 36, and a big jump in 2 years to 36% of doctors in solo practice. So what is going on? Well, what the ADA did is they drilled down to age groups. And what we found is that early stage doctors who are up to 10 years from graduation from dental school, only 17% were interested in solo practice. And that kind of confirms some trends a few years ago that only 1 in 5 dentists wanted to be a solo practitioner. So that's pretty consistent. Now, our mid-career doctors, which many of you may be in that particular category, about 38% were solo. But we look at the later stage, more than 25 years in graduation, still 50% of those doctors are solo. And so a number of those doctors will be looking at associates to bring in for a number of years to complete their exit strategy. And another surprising statistic, which probably for your younger doctors is not such a surprise, but 24% of the early stage career dentists are affiliated with practices having 10 or more locations, meaning many of them are probably working with DSOs. So obviously, the solo model is becoming a thing of the past, and groups are where the action is. So let's talk a little bit about forming a partnership and some of the considerations. When I have my initial interview with a doctor who's considering a partnership, I ask the question, how many years will it be till you want to retire? And if the doctor says to me, well, I want to bring my associate in and or I'm looking to recruit an associate, but I only want to have a partnership for 3 to 5 years, that could be somewhat problematic. So oftentimes I may try to change the conversation to perhaps contemplating a deferred sale as an alternative transition strategy. Why? Because as you're going to learn, there's a lot going on to create a partnership. There are many steps that have to be taken. There's lots of involvement with advisors. It's a lot more complicated than just selling a dental practice, where oftentimes the seller may only stay for a few months or a year or so, whereas in a partnership, we're talking a more long-term relationship. So oftentimes I try to change the dialogue there. Also, depending on the size practice that you have, if you're not really ready for 2 full-time doctors, but you want to bring an associate in, kind of lock that person in so you have your exit strategy kind of completed, you might find that your compensation is going to be reduced. And perhaps you may even have to reduce your clinical schedule to give that new partner to be enough production to be able to afford the buy-in. So there's a lot of variables that have to be considered. And of course, if you are a solo practitioner or have been that way for your entire career, you're going to have to share decision-making with someone else. But some doctors still want to retain control. Why? Well, maybe the candidate is a younger doctor, and maybe they feel they're not ready yet to assume certain responsibilities. So they want to have decision making. That's one issue. Another one is based on, and we'll talk about this later, based on the clinical capabilities of that partner, what type of a buy-in will it be? Will it be graduated or a 50-50? Now, oftentimes, a doctor will say to me, I want a 51-49 relationship. And I try to talk them out of it because there's ways to get around certain decisions for control purposes. But a 50-50 is the way to go if you're considering sharing half the equity. Of course, what's really important too is the practice economically healthy. What's the cash flow like? If you have an overhead of 72%, chances are the cash flow for a partnership might not be as robust. And if that person's been working with you for a couple of years as an associate, they may not see a tremendous increase in their income because there's so much overhead. So that becomes a mitigating factor. Does your candidate show any interest in managerial and marketing activities? And of course, if you do have an associate who's been with you for a period of time and you want to make them your successor, you've had a good chance to observe their capabilities, skill sets, and their interest in business. How about personality? That's a key because remember, you're bound to this person legally and financially. And so personalities do matter. And sometimes personalities have been the root cause of why partnerships have failed. Does your candidate have a good relationship with your staff and other doctors? And of course, this is best evidenced when you have someone who's been working with you. Bringing a partner in off the street is a little more challenging because there's a lot of risk. You don't know who that person is. You have no idea of their clinical competency, their management responsibilities and capabilities, their communication abilities, all those good things. So that makes it more challenging if you're just bringing someone in for an immediate partnership. Is your partner married? And will that spouse have any involvement in the practice? And if so, it should be addressed in advance. Another key consideration is how many active patients do you have? 900 to 1,200 active patients per full-time doctor for a general practice is a good rule of thumb. So if you only have 1,500 total patients and you want to bring a partner in and you want them to be 50-50, it may be somewhat challenging unless you decide to cut back on your schedule. Again, numbers do mean a lot, and certainly patients are critical. And of course, sometimes in cases where the patient base isn't large enough, maybe a strategy is to find another doctor to purchase records from if they're going to be retiring soon to kind of bolster production. And of course, when you have a partner, do you plan to reduce your clinical schedule? Have you been a 4.5 day a week doctor and you want to go back to 3.5 days? You may have to not only do it for quality of life purposes because you want more time off, but maybe you have to do it to support the new partner's production because there aren't enough patients there. So when an associate's ready to become a partner, what kind of numbers are we looking at? From my experience, a good target to have is $40,000 to $45,000 in clinical production. Now, obviously, when we look at partnership economics, we drive that off collections. So obviously, if you're heavily insurance dependent, you really have to look at what your net collections are, because if you're writing off 35, 40%, that may be a challenge as far as the ability for that doctor to make some real money because, doctors pay themselves on collections. And of course, if you have an existing partner, an existing associate, and they've been earning a good amount of money, will the new partner income exceed what they were earning as an associate? That's really what most associates want to understand. If I'm paying X dollars to buy in and become your partner, and I'm making $250,000 as an associate, am I only going to make $280,000 as a partner versus maybe I'll make 400 or 4.25? That changes the calculus, and that's where the young doctor needs to see some numbers relative to the kind of compensation they can earn. Now, sometimes I'm faced with the challenge of two doctors really want to become partners for a whole host of reasons, but there just isn't enough there to make it work. So what I propose is a deferred buy-in. And that basically is when there's an insufficient patient base. And of course, the associate production can't support an immediate buy-in to make economic sense. So what we do in this case is we create a baseline practice value within the first year of this doctor joining the practice. And what we do is we lock that value in because we don't want to deal with the complaint. Well, you brought me in and you told me the practice is worth X, but you want to revalue the practice in 2 years because you want the practice to grow. And how is it going to grow? It's going to grow on the back of that associate, and they're not going to be too happy in paying for that growth. So we try to deal with that at the outset. Obviously, in a deferred buy-in, even though you may lock your value in if you're the selling doctor, you're still going to make a profit on the associate's efforts. And of course, if you tell them they're not going to pay for their growth, the associate can be as busy as they want, work as hard as they can, because they don't have to pay for that. And you'll be the beneficiary by making more money. And how do I know that? I've done a number of these deferred buy-ins, and I've looked at tax returns before and after and see, wow, look at the income that the owner made in the time this doctor was in that deferred buy-in period. And we do update the valuation, however, at the time of the buy-in, and we do it for the time value of money. And what we do is we use the Bureau of Labor Statistics inflation calculator. And basically, with inflation as it's been, it does make a difference. A few years ago, it really wasn't much of a big deal, but now it is. And of course, if there were any new equipment purchased, that would have to be adjusted. And if, in fact, the selling doctor during this deferred buy-in period purchased some patient records, that would have to be accounted into the value. But the key thing is the associate candidate is not paying for the production that they generate to the practice. Now, in a deferred buy-in option, what we do is prepare a practice pro forma. And that's basically a financial analysis where we kind of look into the future and make certain assumptions. And we set goals where we think the partnership is going to be economically feasible. So the associate now knows if they can achieve with consistency 3 to 6 months of performance, the buy-in can be initiated. However, when we have a deferred buy-in, we will pre-negotiate the terms and conditions of the partnership up front. We don't wait till the buy-in is started. We basically get everything ready. So all we have to do is get the financing if we're going to the bank and finalize the documentation. But we deal with all the issues I'm going to be talking about during this presentation beforehand. So if you're still a solo practitioner, you may still file your taxes as a self-employment Schedule C on your 1040. But when it's time to have a partnership, you have to make some decisions. Most commonly, would you become a professional corporation and elect the S Corp? And that's a pass-through, which we'll talk about. C corporations are really not common anymore in dentistry. Years ago, because of pension laws, many doctors became C Corps. And these are doctors who've probably been in practice 20, 25, 30 years because they were motivated to be a C Corp because of certain deductions and most notably having pension plans. But as those of you who still are C Corps, you're a double taxed entity, and that's really not beneficial if we're looking at today's world. Some of you may have converted over time from a C Corp to an S Corp for tax purposes. Many doctors also select an LLC or PLLC. So the common entities are the S Corp or the LLC or PLLC entity structure. And that's where your accountant plays a vital role in determining what's needed. And when I do work with clients in this capacity of forming a partnership, one of the first things I do is I have a conference call with the owner's CPA to understand what's going on from their standpoint, to get their input in terms of what they think is the best entity for their client, because after all, they are preparing the tax returns. And typically the seller's accountant becomes the accountant for the corporation. So let's look at the S Corp first. S Corp is what's called a pass-through entity. And what does that mean? It means that any profit and losses are passed through to you personally and taxed at your rate. The tax law, 2017, IRS Section 199A, allowed for some tax savings by having a 20% reduction of net income with phase outs over time. And the current numbers are the low number for joint filers about 330,000, and the max where there's no longer a phase out at 466. For single filers, it's 182 at the low end, at the high end, 232. So when you're above the high end, there's no more phase outs. And these phase outs are not just 20% across the board, they're graduated. So it's a bit complicated, but again, that's what your accountant can do to give you some kind of guidance. In an S Corp, though, the shareholder must receive what's called a reasonable salary before that first 20% reduction can occur. The IRS has taken a little more of an aggressive stance over the years in this reasonable compensation, which means that what would you pay your associate if they were there? So let's assume that you had $500,000 profit. You wouldn't report all that as a pass-through. You may take a salary of $150,000, let's say, or $140,000, of which you'll pay Social Security and Medicare tax, and then the rest passes through. But let's say that same $500,000, and I've seen this when we do valuations on tax returns of older doctors, where they took a $40,000 salary on $500,000 in income and passed through the 460. That would probably flag your tax return for an audit, and certainly that's what they're looking for, what they call K-1 income abuses. Another pass-through entity, which I mentioned as your other alternative to the S Corp, is the limited liability company, limited liability partnership. Some states are called professional limited liability companies and professional limited liability partnerships. But what's very important about the LLC, which is a little different than the S Corp, is that the legislation is state specific. So the attorney who's going to be crafting the agreements, and we'll talk about having a dental attorney with experience in these matters advise you in crafting the final documents, that they should understand the particular state law and what the restraints are. In fact, in some states, you're not even allowed to use the LLC for a practice entity. You're either going to use a C Corp or a S Corp. Now, with an LLC, an LLP, as you probably can imagine, if you have a professional corporation, you do have liability protection. That's why you're forming an S Corp. Well, the same thing happened when they passed legislation on the LLC. They wanted something a little bit different than the S Corp, and they said, let's form this entity, and this entity provides the same protection as a professional corporation. So any personal assets that you have are protected. However, any assets that are in the LLC are not protected. Obviously, cash, accounts receivable. So oftentimes, it's no surprise why your accountant may have said, if you own your building and it's maybe in your name and your spouse's name, they may have said, you know what, I think we ought to form an LLP to own the real estate. And why did they do that? Well, not only to have two taxing entities, but also to protect you. God forbid one of your patients slipped and fell and they sued you. And if you were still a proprietor of the building, that could be very costly. So, many accountants have advised their clients with real estate to form the LLC, but we also feel the same thing to be true in this kind of entity. And of course, for a partnership, as you'll see, there's some pretty good reasons why this may be a beneficial one. However, in an LLC, and same thing with a PC, you're not shielded from malpractice issues. The same section 199A we talked about before with the upper and lower thresholds still relates because it's a pass-through entity. Unlike a PC where you're a shareholder, if you're in an LLC or an LLP, you're called members. And the big difference, and why some people like this feature of selecting this feature, that the distributions can be allocated disproportionately, whereas they can't be done that way in an S Corp. In an S Corp, it's based on the ownership percentage. So that's a big, big differential. The compensation is called guaranteed payments, not officer comp. And typically it's not W-2 income, it's paid as a draw. And consequently, you then file your taxes quarterly. Now, a lot of doctors who've been solo practitioners their entire life, who are used to paying their taxes quarterly, don't want to get into W-2 income and everything else and pay taxes like they do with their staff and hold them back. They'd rather stay with the quarterly estimated tax. So that's really, again, an accountant-driven decision with your input, of course. And then any personal items that are paid through the practice can be charged against the draw. So those are some of the features. Now let's talk about some of the major issues in partnerships. Well, the first hurdle is the buy-in. How do we get there? And there's a lot of things that need to be done to create that buy-in. And equally important, and where it's more important, candidly, is where we have older doctors whose partnership timeline is maybe 10 years or less, maybe 12 years. I said earlier, if it's going to be 3 or 4 years, we may change the recommendation for a partnership. But a buyout is real critical because you were solo, you brought someone in, but you want to have an exit strategy. So we got to negotiate the buyout. So we'll talk about that and how we deal with that. And of course, operational issues are very important. We'll touch on that. We discuss some of the key points in the partnership agreements. Now let's talk about the different types of partnership buy-ins. And there are several. Many doctors, young doctors particularly, want to be a 50-50 partner. And that's laudable. But is there production there to support it? Because what's the sense of having a 50-50 partner if that partner really isn't producing anywhere near the senior doctor? So that needs to be factored into the calculus. And of course, if there is inadequate production, or if the doctor is just out of residency, but you're in a small town, you want to lock this person in because 2 of your other buddies who are your age are looking at the same candidate, so you want to lock them in as your partner. And I've seen this happen. I've been involved in a number of small town deals like this, and it can get pretty competitive, especially if that candidate is from that same region, because they know people. So it becomes a very competitive thing. But nonetheless, if you're going to have a younger doctor or a doctor not producing as much, it may be wise to have a phased buy-in. And typically that's 10 to 15% of equity purchase up to the 50% level, if that's the goal. And usually these types of deals, with maybe the exception of the first partnership interest purchase, are financed internally. Okay, and we're going to talk about financing as we go along. Another thing to consider, and some advisors believe strongly in this, when you look at a doctor who's not producing at your level, but they want to be a partner and you want them to be, and you don't know how to figure out, well, what should I offer them? You may simply look at the ratio of the candidate's personal clinical production as compared to yours, and that may give you some guidelines as to what type of a partnership interest you want to offer them, with the understanding that over a short period of time, they'll reach parity with you. And of course, if you do have a partner who's not equal to you, there is a discount of control. And so small discount to Goodwill is usually warranted. Now, unlike selling a dental practice, which is pretty straightforward, when we sell a dental practice, we sell the assets to the purchaser. And the allocation is pretty straightforward. And the tax benefits are pretty straightforward. However, the biggest challenge that I face when we do these deals is setting up the appropriate buy-in structure, and that it means the tax consequences, because there's a buyer and seller and each has advantages, disadvantages. So there is where we are. So the first structure is a stock sale, including the goodwill. Another one is a stock sale, excluding goodwill. And finally, the asset sale. Those are the three types of equity transfer strategies that we're going to discuss. And some have more tax advantages to the buyer than others, to be quite honest with you. So let's look at the 100% stock sale. That is an ideal scenario for the seller. And why? Because the doctor receives complete capital gains tax treatment. In all honesty, it has the least amount of IRS scrutiny because, as we'll see in a minute, in these kind of deals, the IRS is assured that all the taxes are paid by the buyer and seller. Capital gains is pretty straightforward, and the buyer, as we'll see, it's after tax dollars after they've earned their income. However, when we have a situation where the advisor for the seller really says, I don't want to consider multiple entities or other strategies. I'm a very conservative accountant. I don't want my client to get audited. I want the least riskiest solution, and this is what it is. So the buyer will get their advisors, and they're not too happy with that, and they will try to change the structure of the deal. But one way to mitigate that as a compromise is to have a reduction in the buy-in price as a concession to the fact that, as we'll see, the purchaser is going to pay for this in after-tax dollars. So it's a trade-off. It's kind of matching what the buyer is losing in tax benefits. The seller is gaining all the tax benefits. So there's got to be give and take so everybody's happy. Now, on the purchaser side, the one problem with the complete stock sale is that the purchaser pays income tax on all the compensation earned. And the stock purchase is not deductible. And the big difference here is it's paid in after-tax income. It's akin to having another mortgage payment. So that's the real big issue. And let's underscore that with numbers. Let's assume that the value of the stock that I'm buying is $500,000. And I'm going to borrow money, and my interest for the loan is going to be $94,000 over the long term. My personal income tax rate is 32%. So we take the reciprocal of 32, which is 68, divide that into the total stock value and loan interest, and it's a whopping $874,000 we have to earn to pay for that. Pretty expensive. So that's why advisors for buyers will try to move the needle, either getting a nice reduction in purchase price, so there's some offset there, or consider other options. And what's another option? A stock sale excluding the goodwill. What do we mean by that? Well, typically what's done is the tangible assets are oftentimes allocated to the stock. Now, as I mentioned in prior webinars, looking at allocation of intangible and tangible assets in the practice's value, it's usually around 25% allocated to tangible assets and 75% allocated to intangible. Now, that's going to vary, right? If you have a more modern, up-to-date equipment, maybe more like 35, 65, something like that. But it's a good ballpark to use. So about 25% is allocated to tangible assets. Some accountants like to use 20% just as a rule. Again, that's up for the accountant to make that determination. And that, of course, that's going to be paid in after-tax income, and it's usually paid in cash or the promissory note. So the big difference here is the goodwill component. That's the majority of the buy-in value. And what we do here is we have what's called a compensation shift, where the seller is going to receive compensation for their goodwill interest. However, the downside of that strategy, unlike when they sell 100% stock, about 75% of this deal for the buy-in is going to be classified as ordinary income, because that's what a compensation shift is. You're basically paying the doctor a fee, a management fee, And if you're doing it, what we like to do is, okay, what was the effective capital gains rate of the selling doctor, and what is their effective state and federal income tax rate? And we take the difference between those two and we add it to the payment that the doctor who's buying in has to make. Plus, we impute some interest because it's over time. Because these deals are not done with cash, they're typically done financed through the business. And so the real benefit to the purchaser is that this part of it is a pre-tax item. Unlike the stock sale where they're paying in after-tax dollars, it's a pre-tax item. Again, has to be carefully structured, and the IRS, has to be, always aware that they're looking at things and make sure the agreements are written appropriately so there's no flags. And so, if we were to look at this over time, we could see that we have a $500,000 buy-in. We're going to have total payments, and let's look at how it might work. Doctor's compensation is $300,000. Let's say the annual payment was $90,700. So consequently, the doctor's comp would be $209,000. Now, another method, which is more commonly used nowadays by a lot of advisors for buyers, is the asset sale using multiple entities. And in this case, Dr. Senior usually is a C or an S Corp, and they're going to retain that entity as a partner. So in this type of partnership, if you're entering into a three-entity partnership, you individually, the doctor owner, is not the partner, it's your entity is the partner, okay? Then Dr. Junior is going to form a business entity as a second partner. Usually it's an S Corp, it could be an LLC. And then you're going to form a new company. It's called the operating company. And that usually is an LLC or an LLP. And that will file, their tax return would be a general partnership, which is Form 1065. So in a three-entity arrangement, now we have three different tax returns, plus two personal tax returns of the owners, right? So there's 5 tax returns in this particular arrangement. A lot more accounting, but there are significant benefits, particularly for the buyer. So what happens is Dr. Junior's entity purchases a fractional interest in the tangible assets from Dr. Senior's entity. Okay, so they're gonna buy something, right? They're gonna buy some equipment. Dr. Junior's entity is going to purchase the personal goodwill from Dr. Senior or his or her entity. Okay. Now, if we are dealing with a C Corp structure, which we usually don't, then we have to consider a separate goodwill valuation because of certain IRS requirements and restrictive covenants, which we're not geared to get into with this brief overview. Suffice it to say, the 95% of the deals I see now, like PCs or S Corps. So, what are the benefits to the purchaser? Well, first of all, they can depreciate the tangible assets any way they want. That's a significant tax benefit. Equally significant, but not as dramatic, is the goodwill, which is a sizable number, right? And that would be amortized over 15 years. And if we're going to do a cash deal, or if it's an installment deal, if we're paying through my entity as the purchaser, we now have deductible interest payments, which we didn't, albeit maybe to a limited degree, if we just purchase stock. So you can see why many advisors for purchasing doctors prefer this arrangement. Is it more complicated? Yes. Is there more accounting fees? Yes. But one has to look at, how long is this deal going to be for? Is this going to be a 10, 15, 20-year partnership? Is it going to be a short-term partnership? All these kinds of things may play into the calculus of how we make these selections. And so you can see why some accountants for the sellers who are a little bit more conservative and who don't like these things because they think there's too much there to be risking as far as audits, et cetera, they say, no, it's too complicated. Let's just do the stock entity and that's it. So we've had some deals fall apart because the parties couldn't agree at the outset. So you can see that when I get involved in these things, this is what takes the most time, particularly if we're going back and forth, and it can be problematic. So, informing the operating entity for this multiple entity transaction, the entity now pays the majority of the operating expenses. By that, I mean all the revenue from both doctors comes through the operating entity. Bill the patients, files the e-claims, collect the fees. They have to do the insurance credentialing, all that kind of good stuff. More importantly, all staff members become employees of the operating entity. So the profits are distributed to each partner and reported through their respective entities. So all the bills are paid, rent, you name it, everything's taken care of by the operating entity. There's money left over, and we know who it came from based on the compensation formula that we'll be addressing. And so that's then reported through their own respective entities. And by having their own entities, if they have certain expenses, they can run those expenses through their entity and have them paid by that S Corp or LLC. Many years ago, partnership deals were all seller finance, just like back in the days of the early 80s when interest rates were 18%, when doctors sold their practices, there were no banks offering acquisition loans. It was all seller finance. But obviously, we've changed a lot in the last 20 years or so. And so now banks will finance partnership buy-ins. And of course, sometimes they consider them less of a risk, particularly if the senior partner is going to be hanging around, for a period of time. There's less chance for loss of goodwill, like could happen in the case of 100% acquisition. And there's usually better management continuity because the doctor's owned this business. He or she knows how to run their practice. They have stable workforce. All the variables that sometimes get in the mix when you buy a practice and the owner retires. Banks are sometimes pretty happy with this. When it comes to financing, the senior doctor will not make a personal guarantee on the loan. And oftentimes the doctors say, well, how are they going to pledge assets? They're not going to take real estate from the buyer because they may not have it, or they just have a fresh mortgage. What they're going to do is there'll be what's called a corporate guarantee, not the personal guarantee. The corporate guarantee means if the junior doctor decides they don't want to be a partner anymore, leaves the area, stops making payments, guess who's going to knock on your door? The bank who gave you the money for the 50% interest. So you basically have to pledge your assets as collateral. That includes accounts receivable and everything else. So some doctors and their advisors don't like this approach. But if they want to get the cash, that's the price they have to pay. And of course, the worst case basis, if the doctor leaves, then you can sit down with the bank and renegotiate the loan and hopefully hire another associate or two, depending on the size of the practice. And life goes on and you pay off that loan, but you had the ability of that cash in hand. And if you invested it and if the market is doing like it's been doing, that may not be such a bad deal. Again, these are things that have to be considered when you accept cash. And where we run into some difficulty is when the senior partner has a lot of debt on the books. So there are some strategies that have to be considered. Sometimes we do some creative lease creations and things where the doctor maybe has $800,000 of equipment and technology, and they don't want to have a reduction in their price, so we form leases. So it gets complicated, and sometimes we need some tax attorney involvement. So you can see there's just a lot of nuances in this partnership stuff. Now, some doctors don't need the money, and they'd rather provide all or a major portion of the funds, and that's perfectly fine. However, there must be a fair interest rate charge. Minimally, it has to be at least the IRS interest rate, which can easily be found online. But typically we suggest, well, since you're the bank and you're taking some risk, maybe you'll charge 1 or 2 points higher than the local bank may charge because you're not a traditional bank. You're still taking that risk. So again, that's something that has to be negotiated. And it can become an installment sale for Dr. Senior, which could have some tax benefits. Now, when we look at a buy-in, sometimes the doctors who are purchasing an interest don't think about this, but it's not just the partnership value. As you recall from our valuation webinar, valuations in the dental space normally do not include the following: accounts receivable, cash, and any debt. That has to be taken into consideration. Same thing holds true in the partnership value. Here, we add any accounts receivable if the doctor is buying the accounts receivable and take away liabilities. Because one of the things that we need when we form a partnership is what's called working capital. So if I'm a solo practitioner today and you become my partner tomorrow, we have a new business, I may have a lot of accounts receivable. But those accounts receivable belong to me, net any liabilities. So what that new partner has to do, we have to form what's called capital accounts, and we've got to put new money into the business. And oftentimes the new candidate or partner will buy some accounts receivable, and that would be a portion of working capital. So again, those are things we get into in our consulting, but just I mentioned why that's important. So there's a net buy-in value. And then we take that net buy-in value, multiply it by ownership. So let's put some numbers to the page. $1 million value, net AR. What do I mean by net AR? Net any uncollectible accounts, etc. Liabilities of $50,000. The net value would be $1,050,000. And if I'm buying a 50% interest, it's 5.25. Now let's talk a little about partnership contract issues, because there are many things that need to be factored into. And the reason these are important is they're like governing rules. And there's ways to solve problems. Issues are addressed, remedies are suggested and memorialized in the agreement. Unfortunately, in my career, I've dealt with partnerships where the doctor said, well, we just had a handshake for 25 years, but now they can't agree on anything. And you can imagine how messy that can get. Or we had an agreement prepared by our attorney. We never signed it. So there's no contract. So we're big believers in getting this done. And when we consult with our clients, we do not prepare the contracts. What we do is we prepare what's called a term sheet. And the term sheet is nothing more than all the key components contained either in an operating agreement for an LLC, LLP, or a shareholder agreement, employment agreement for the PCs. So we try to talk about all the things that could happen. How are they going to be addressed so that, God forbid, something does happen, there is a path that is illustrated in writing. So when we have an LLC and PLLC, we have a couple of agreements. One is the ownership interest purchase agreement. What kind of ownership interest are we buying? And then the operating agreement, which is the governing agreement. How are we compensated? All the things I'm going to talk about are included: death, disability, premature withdrawal, governance, spending authority, admission of new partners, you name it, they're covered in that document. And a lease if the doctor owner owns the building. And many times doctors, charge themselves any kind of rent that they want. Obviously, when we do valuations, we try to normalize that lease in our valuations. And more importantly, if I'm going to become your partner and you're charging an above average rent, it needs to be a fair market rent. So that has to be negotiated. So it's a fair deal, arm's length transaction. Now in the PC, we have the stock purchase agreement to memorialize the purchase of the stock interest, the number of shares, the stockholder or shareholder agreement, which are the rules and regulation of governance, and the employment agreements, because in a PC, we receive W-2 income as an officer. So we have to have an employment agreement and a lease, of course, if the owner of the practice owns the building. So how do we share income? And there's lots of different ways. And I'm just going to cover two briefly, but there are other methods that can be used, and some are more complicated than others, again, based on the characteristics of the partnership. So what we drive all our computations off is what we call available partner compensation. And we define that as net collections of the business minus the normal operating expenses, salaries, rent, accounting fees, certain insurances, you name it, what it costs to run the business. And what's left over is available partner compensation. And so all the fringe benefits that you're going to receive as a partner are included in this number. And that drives how we figure out how you get paid. So let's look at one method, which is called a relative production and distribution share. By that I mean, we're going to determine the percentage of available partner compensation, and that's allocated to the partner's clinical production. I'm going to show you a mathematical example, so this will be a little more clear. We're going to multiply that production component by the available partner comp. So what we're doing when we do a relative production model, we divide your compensation into what's called two buckets. One's a production bucket, one's an ownership bucket, okay? And in the production bucket, we typically start with 50% of the available partner compensation and allocate it to that bucket. The other 50% is allocated to ownership. Now, in cases where the doctors may have a significant difference in their compensation ratios, we may choose a higher number because the one doctor is contributing more. So again, we run models, we can change the numbers to show the client the impact of raising or lowering that bar. But that's the concept, two different buckets. And take an example. Available partner compensation is $800,000, and we're going to use the 50% production and 50% distribution bucket model. So 50% of 800 is 400, and distribution is 400. So Dr. A has a production ratio of 55% this year. Dr. B has a production ratio of 45%. Hygiene is not included. Hygiene's on the side. Now, of course, many times the doctor's exam is part of the partner production, okay, but not the actual hygiene production. So for Dr. A, since we have the production bucket of 400, right? We multiply that by 55%, that equals 220. And Dr. B, her bucket was 400 times 45%, so 180. Both partners are equal partners, so they each share that distribution bucket equally. So Dr. A, 220 for production, and 200 for ownership, 420. Dr. B, 180 production comp, and 200 for ownership comp, 380, $40,000 difference. Now, another way to do it, if you really want to get involved in a commission-based compensation, because that's how you used to pay your associates, you can do it that way too. Typically, we establish a monthly draw, and then from that, we're going to pay a commission. And usually for GPs, we use 35 to 37%, and for specialists, 38 to 40. So basically, in this model, we're paying you as if you're an employee in your business. And we can or cannot deduct lab, ortho, implant expense. That's up to the individuals. So we run those numbers as well. So let's assume that we had a situation where Dr. A's commission compensation based on the percent commission we use was 210 and Dr. B's is 180. So that's 390. We then take that number, adding them up, and we come up with 410 as a distribution pool. So commission example, Dr. A makes 415, Dr. B makes 385. And if you recall, use the same base numbers, it's only a $5,000 difference. And I can tell you that oftentimes the difference in these methods is rather minimal. So unless there is a real disproportionate use of clinically related supplies, etc., sometimes the doctors opt out for the bucket approach because they don't have to track lab and other supplies. So this requires a little more accounting. Again, personal preference, whatever you're comfortable with. Now, since we're dealing with pass-through entities, we have what are called distributions or bonuses. And in an S Corp, it has to be distributed based on ownership. So it's a 50-50 deal. If you have $300,000 to be distributed, each doctor gets $150,000. If we're in an LLC, you have the option to change the calculus and base it perhaps on the production ratio. So let's say we had that same 300,000, and let's say that Dr. A was at 60% and Dr. B was at 40%. Well, we could take 60% of the 300, that would be 180. 40% of the 300 should be 120. You can see it; it's not equal. So that's another thing that has to be considered. Is that going to be an issue, or are we just going to be governed by straight sharing of profits? Typically, the partner fringe benefits are charged against distribution bonus share. And how often are they paid? It really depends on the client and the accountant. Usually the accountant's the one who's figuring that out because they're the ones that have to prepare the K-1s at tax time. So they're either paid quarterly, semi-annually, or annually. Some doctors like monthly. It's up to really the accountant and the cost involved in the monthly distribution. In cases like that, where there's cash flow concerns of the junior partner and they want distributions more frequently, I would opt to create a higher draw, and we can always adjust that at the end of the year for better cash flow security for the buying doctor. However, one thing that folks forget is you don't drain the checking account when you take a distribution. You've got to have a minimum account balance before distributions can be made, because you don't want to put the practice in a cash flow bind because you took all the distributions. Now, it's one thing to take the distributions at the end of the year, but I'm talking during the year. So again, sitting down with your accountant and determining what type of a checking account balance we want to keep in, and anything above that balance, we can draw out as a distribution, just as better financial management. Time commitment is important. And so in the agreements, are we going to have a mandatory retirement age? And what age will that be? Where I'm always challenged when I'm dealing with 35, 45-year-old partners, and they're both around the same age, we talk about mandatory retirement, they can't even answer that question. Most of them usually give me a lower number. There's no right or wrong answer. Whereas if I'm dealing with a doctor who may be in their 50s and early 60s as a senior partner, they can be a little more definitive and precise about that retirement age. But what that simply means is that you reach a certain age, you're forced to sell your shares unless the partners agree to change it. More importantly, though, where I've seen abuse in my career is where doctors aren't carrying their load in the later years, either because they don't want to work as hard. They now have, maybe a place in the Southeast or a place in Florida, wherever they like to go, and they spend a lot of time there, and they're not around as much. And the junior partners really work hard, same overhead. We're not laying off staff. That's always an issue, right? So it gets to be problematic. So to kind of level the playing field, we think it's a good idea to state, okay, what are the minimum number of days or hours that partners have to work to retain their partner status? As simple as that. However, sometimes we've seen abuse where they work their minimum days and hours, but they're hardly doing anything productive. Maybe they're doing some simple operative and some hygiene checks as opposed to what they used to do, so that their production is pretty bad, even though they're working their minimal hours and days. So you might want to consider minimum production goals. Patient distribution doesn't always occur. If you have a patient-rich practice, it's a non-issue. But what has to be remembered is that the entity remains the trustee of all the patient records. And, if there's decisions on who gets patient A and patient B, it could be based on patient preference or who calls first. Again, I don't see that as often in most practices. In fact, some practices might even want to have some specialty referral restrictions as well. So again, the whole idea is just to have an equal distribution of patients. Now, unfortunately, things happen in life, and we have partners that can become disabled. And so the definition of disability has to be clearly stated. Sometimes the attorneys rely on the definition created by the insurance companies. So they're the ones that are paying the claim, and they will decide whether the doctor's disabled or not in their mind's eye. However, some like to have definitions written into the agreement. So again, that's part of the discussion and negotiation that needs to be taken into consideration. But more important to that, if something happens to either partner, should there be any discounting? And if so, what percentage? That's a tough one, because unlike when someone leaves voluntarily, they had no control over what happened to them. So should they or their family get full value, or will there be some discounting? And what are the buyout terms? So basically, cross-purchase agreements are common for two doctor entities, but if we're into multiple partners, we have entity agreements. And so we have to consider life insurance, personal disability that hopefully all doctors have, which is tied in. If they're out in disability, how much does the practice pay draws before they stop paying because the doctor's not working anymore? Is there still office overhead? And if in case of younger doctors, they may qualify for a contract which allows for some insurance buyout of value, just like life insurance, but never at 100%. Now, one of the conversations we do get in sometimes is management responsibilities. If Dr. Senior has been at the helm 20, 25 years and spends a good 7, 8, 9 hours a week doing a lot of things, whether it's if they're a real whiz with marketing, SEO, they're really good financially, they oversee payroll, they're dealing with tax matters, they're dealing with the pension plan. They all take time. And if that doctor didn't do those procedures, would you have to hire someone else? So that's the conversation that we try to get into. Should the senior doctor, if the junior doctor does not or cannot take on certain responsibilities, should that person be compensated for the time? Because if they didn't do it, you'd have to go out and hire someone. So those are discussions that we always have. And then we come up with some type of a salary based on the responsibilities. Some practices, instead of giving a monthly salary, will have some kind of a year-end bonus on percent of gross receipts or profit. Again, the whole idea is to acknowledge that. Is there a differential? Should it be paid for? Now, sometimes partnerships don't make it to the finish line. And oftentimes the junior partner may decide to leave for whatever reason. And so the question arises, if someone leaves, like in a year or two, should they receive full market value for their interest? So again, another thing to be debated and really negotiated. We typically find that if someone leaves voluntarily in the first 5 years, there should be some type of discount. So the senior doctor who made all the effort to recruit this doctor and all the expense of forming this partnership and all the things, maybe they took a day off to let the other doctor make more money so they could take their production, you name it, whatever the issues are. Bottom line is, should they get full value? We think they shouldn't. Over 5 years, it's a declining percentage, obviously highest in the first year. Okay. On the flip side, if a senior partner decides to leave before their official retirement age, do you want to have a discount on that, on the senior partner? Again, these are all points that need to be looked into and fully vetted and discussed. In the unlikely event of a dissolution, we have lots of issues to deal with. Phone numbers, particularly in multiple offices and specialty practices. If there's a call center, whatever, that has to be dealt with. How about URLs for websites? I've seen issues there where one of the partners wants to take the website, the other partners don't want him or her to have it, even though they're not in the same area. That becomes contentious. So that has to be dealt with. Are there any lease obligations? If so, who's going to take care of those? If the one partner owns real estate, does the partner who's leaving entitled to any relocation expenses based on why did the partnership dissolve? So again, these are all points that just need to be discussed. And then what about staff retention? Now, the biggest issue that we face with partnerships, particularly with two-doctor partnerships, is the buyout. And I mentioned that's the third component: buy-in, buyout, and of course operations, which we've been talking about here. Is it an option or a requirement? And if it's a requirement, if that option is not fulfilled, should there be liquidated damages? Where this becomes extremely important is doctors who practice in small towns or rural areas where you don't have an influx of candidates. In the urban areas, it's not as big a deal, although it can be, because if the junior partner doesn't buy the senior partner out and the senior partner brings in someone that's going to give him or her his full value because the junior partner did not want to buy him out, that could become a pretty sticky relationship. So one of the things we also do to create fairness is on the buyout side, we adjust the goodwill of the buyout value based on the relative clinical production of the departing partner. Why? Because we've seen situations where the departing partner is really maybe only generating about 40% of the total production, and the junior partner, so to speak, is at 60%. Should the doctor get 50% of the value? We say no. We should get less because they're not producing as much. They don't have as many patients. So again, these things we discuss in the beginning before a contract is even signed. We try to look at what could happen, what can be resolved, trying to avoid all kinds of issues. So let's talk about future buyout. Is the partner going to remain as an employee or new doctor replacing the outgoing partner? So it's appropriate that the senior doctor give at least 12 to 18 months notice to his or her partners that they're leaving. So there's adequate time to find a replacement if they're going to stay just for a short period of time or just retire. So that needs to be dealt with. And there are financial and tax considerations that need to be factored in as well. If it's cash, it's usually a straight capital gains if it's a stock sale. However, if you select the second option, we're using a compensation shift. Usually the way that has to be handled at the buyout is deferred compensation. And deferred compensation is a great tool for the partners buying out the doctor because they get a complete write-off. However, there are restrictions that the IRS has placed where there are no lump sum payments. There's a certain way the deferred comp is calculated. But the two important things that have to be considered by the partners buying out the doctor is in deferred comp, you cannot have a restrictive covenant on the doctor senior. Now, if the doctor is an older individual, maybe they don't really care. But again, that needs to be figured out. And also, if I'm the selling doctor, what happens if I don't get paid? What happens if they're not making payments on a timely basis? So those are things where deferred comp may sound really good, but there are some downsides to that on both sides of the equation. So I covered a lot of ground in this conversation, and I hope that you now have a better appreciation of what partnerships are all about. It takes us 3 to 4 months to do what we do when we consult with our clients because we're working with advisors. And this is before we even develop the contracts. When somebody calls me up and says, I need to have a partnership in a month, I usually tell them that we can't help them because I know what goes into these things and the kinds of conversations we have to have. It's a complicated process, but one that can be extremely rewarding if you do everything right and have open and honest communication. So if you have any questions, I'm sure there will be some. Feel free to get through to us through our website, henryscheindpt.com, or you can simply call at 800-988-5674 or dpt at henryschein.com. I'll be happy to answer some questions because I'm sure I covered some things that you're probably scratching your head saying, well, what does he really mean by that? How does it apply to me? I'm an orthodontist, things like that, because we can't cover everything in the hour that we have together. And of course, as you know, as part of the Henry Schein Dental Academy, there are lots of webinars, not just in management, obviously, but in the clinical arena, financial arena. So we encourage you to go at webinars at henryschein.com. So again, it was a real pleasure to be with you, and I hope that you found this time together to be worthwhile. Continued best wishes. Have a good day.